All right, welcome everyone. Thanks for joining us here today. We're going to talk about automated options trading. Looks like we're getting started right on time. And if you're here for the first time, welcome aboard. I see sometimes we have repeat visitors and viewers, and that's great too. So we're going to get through a lot of material today. And I know everyone's busy in their day-to-day routine and their schedules, but we're going to look at something interesting with our proprietary solution on how to automatically trade options. And we're going to look at some unique trade alerts you've never seen before. We don't have to watch the screen or babysit our trades to do this. And we're going to look at how to automatically manage the trade, whether it's for a profit or risk, once you have the trade in your account. So remember, we're speculating, and as we speculate, we accept risk. There's always risk of loss. So do take a moment and look at that risk disclosure. It is important. Remember, when trading, all funds committed should be risk capital, and past performance is not a guarantee of future results. A little bit about Altivest. We've been trading since 1997. We are an introducing brokerage firm, 27 years of serving our client base. We've traded millions and millions of contracts along the way. We are the creator of the Dragonfly option strategy and our proprietary order execution technology. So clients have been using this to trade millions of contracts with our solutions. We are registered with the CFTC and a member of the NFA, and we're located in California. And just a brief bit about myself. I am Eric Gebhard. I've been doing this for over 30 years, co-founder of Altivest. I was licensed back in 1991 with my commodities license after graduating from the University of Southern California with my BS in Business Administration. I did get involved in the securities industry initially with my Series 6 and 63 licenses, and I currently have my Series 6 65 license. That's for the investment advisor space. Okay, so with the brief introduction out of the way, I'm going to go ahead and turn off the camera. You get more room on your screen that way. And we're going to look at algos and how the algorithms are dominating the landscape and how we think you should try to compete with the machines, let's say. So JP Morgan estimates that 90% of US equity trading volume is systematic or algo or machine driven. So can we use algos to trade option spreads? Yes, we can. And we might want to look at trading options like a large institution would do it. So how would an insurance company, for example, trade options? Well, maybe similar to their model now, which is you pay them premiums to assume risk, so they receive the premiums. And essentially they sell and manage time. They insure themselves along the way by always hedging their risk. And they're consistent. They have a process in which they use patience, and it's a repeatable process, and they look at math and probabilities and look at the longer term odds to favor them. They look at statistics and so forth, a lot of number crunching, and that's what we want to try to do here. May the odds be ever in your favor. So that's our goal here, is to try to trade options with that in mind and collecting premium collection strategies. And it's not just premium collection that we're going to talk about, but we're going to focus on that for the moment and for the most of the majority of the presentation. So manage risk and reward, not getting greedy. You'll need experienced help along the way. You'll need the correct tools for automation to simplify matters for you. And these are not trades where you could expect a grand slam. These are lots of base hits, singles. You want to reach base with these types of trades. And you can be directional, whether you're bullish or bearish, or non-directional. We'll talk about some unique strategies for that. And each outcome is targeted with a fixed risk in advance. So before we jump into the demo, we're going to learn 2 letters from the Greek alphabet. First one here helps us determine probabilities, and that's called delta. And what does that mean? What is the definition? How much does the option value change with a change in the underlying asset price? And another way to look at it, option traders view it as the approximate probability of an option expiring in the money. So an example of a delta 0.25, at that moment there's a 25% chance it expires in the money, and then a 75% chance that would expire worthless. So remember, delta is always moving with price and time. It's not a static number. And it is not the probability of a winning trade. So that's important to keep in mind as well. And theta is the other Greek letter here, and that's referencing time. So when you're speaking of options, options have a limited life. They always expire. And theta refers to time as a negative number equaling 1 day of time decay. So every day lost is impacting theta. So if an option's at 10, then theta is negative 0.05. Then the next day, your premium would drop to 9.95, and the next day after that, 9.90, and so on and so forth if you only were looking at theta or time decay. And here's what that looks like on a graph. You'll see here as you approach time 0, the amount of premium drops and drops and drops, and eventually you have 0 time left, and theta is going to end up here at the end of 0. So Wall Street professionals trade option spreads to collect premium. So we're going to look at some examples of 5 spreads here. First example, we'll go through these quickly and then we'll just use more of our time in the demo. But here's a call spread where you might sell an out-of-the-money call spread on the E-mini S&P 500 stock market index. And we'll talk about why we look at the E-mini a little bit later. So here's a trade if you're bearish or even moderately bullish, or you have no direction in mind. You'll see here this red line represents the call that you sell, and you collect 4.5 points for selling that call. The blue line represents the call that you buy as a hedge, and you pay 2.25 points for that. And the net result in this example, you collect 2.25 points, $112.50 minus any fees, of course. So, and you look for the market. You can see the market here trading, goes down, it goes up, but you really want it to simply stay below or not get too close to this spread here that you have sold. And then here's the inverse of that. You're looking at a put spread. Here's the graph of that. Here's the put spread that you sold, and as long as the market stays, generally speaking, above the red line there, then that put spread should work well for you, where you end up selling it here in this point in this particular example for 100 points. You collect that money, you put it in your pocket, and then the idea is as time goes by before expiration, which you can see here's this vertical line, then you would buy that spread back. Maybe you buy it back for $20. So the net result is you make $80 on that minus any fees. So here's an example of a condor, iron condor, and it's a non-directional strategy, and it's just simply combining those 2 strategies we just looked at. Here's the call side of the spread and the put side of the spread. You collect premium by selling this call spread and this put spread. And then you are looking for the market to move around in between the boundary on the upside and the downside here. See this wide margin of error there. You can see the expiration date here. So that's what an iron condor spread looks like. And then here's what you would plan to do with it over time. You see the market has moved sideways, gone down, gone up. And right here, you'll see this blue arrow and this blue box here called the RTI, and I'll show you that in just a moment. But that is the signal to take a profit. So as theta decay has worked, you've collected premium for selling that spread initially when you started the trade, and as time ticked away, you were able to buy that spread back at a lower price than what you sold it for. So that's the whole idea of how to trade any of these short premium collection strategies. Now here's the unique strategy called the Dragonfly that we developed. There's 6 legs. It's a variation on the Condor. And here's what it looks like. You'll see the calls here and the puts here. And you'll notice you sell 4 of these calls, buy 3 further out of the money calls, and then buy 1 closer to the money call. And then for the puts, it's the same structure. You sell 4 puts, you buy 3 further out of the money puts as protection or hedge, and then buy an additional closer to the money put for an additional level of protection or hedge. You'll notice the put that you buy here is 50 points closer to the money compared to the 4 that you've sold. And the same thing with the call here, 50 points closer to the money compared to these 4 that you have sold. And we have a way to automatically select these trades, and we're going to show you that in just a second. And this is what the Dragonfly looks like, and let's take a look at what happens after theta decay in an example. So you can see the S&P here in this case dropped, rallied, and then right here you get a signal on this day to buy back the spread and take your profits. You can see the expiration date here. So you're out of this position well before expiration. So you've sold it, and then here you buy it back for less than what you sold it for. And that's how you would hope these trades work for you. Of course, they don't all work out for you. We're going to show you how to manage risk as well. You can be bullish or bearish as well. You don't have to just be non-directional with the Condor or with the Dragonfly. There's something we call a bull hedge or a bear hedge strategy. And of course, there are other strategies as well. But here's an example of a bull hedge strategy where you might be bullish on the market when the market's trading here, and you sell an out of the money put spread, and with that money you receive, you buy an out of the money call spread. And if the market rallies quickly enough, that trade would more than likely do well for you. And we're going to look at that in just a second. So stick around here. In just a few minutes, we're going to show you something really cool. We're going to respond to a live trade alert. And we'll show you how that works as well. You'll just simply touch accept or reject, whether it's via a email or on your dashboard, or you'll receive that on your smartphone as well. So here's the question you have, I'm sure. How do you create all these spreads? Which markets are you going to trade? What strategy would you apply? And at what price, or what's the proper timing? And how do you manage your risk and your profits? Very good question. And the answer is ThetaTrader. These are pre-built option spreads. Our proprietary algo creates theta trades each day, a menu of possibilities for you to look at, as well as you'll receive one-touch responsive trade alerts, something you've never seen before. And any condition, any strategy, strategies are available for any market condition, I should say. Then we use the automated risk and profit tracking called the risk thermal indicator. All right, with that said, let me switch screens here. And give me just a second. We're going to switch gears and look at the live demo now. All right. So you're now looking at my dashboard for ThetaTrader. And you'll see here, I want to make sure that everyone can see it before I jump in. So give me just a second here to double check that. Can everyone see my screen okay on the ThetaTrader dashboard? Let's take a look here. Sometimes these webinars can get a little glitchy. And, oh, just a second there, folks. Let me make a little quick comment here in the chat. Okay. Yep, I think we're good. So you're looking at the ThetaTrader dashboard here, and you'll see up above there are theta trades. These are open short positions here, any open long or bought positions. And then you have your current quotes as well as your account info right here listed. Let me make this a little bigger. And then you'll notice here there's an active trade alert, and we're going to show you how that works in just a second. But first thing here, we'll look at the theta trades for today. There are bullish and bearish and non-directional or neutral strategies here. And you'll notice three markets we can choose from: the E-mini S&P 500, the NASDAQ 100, as well as the Russell 2000. And again, I'll show you why we look at those particular markets a little bit later. Now, you'll notice here the strategies are all pre-populated for us, and depending on your outlook. And we looked at condors and dragonflies just a moment ago. So why don't we look at some condors for today on the S&P 500 mini. You'll see trades are available anywhere from 16 to 51 days till expiration. And you have your potential profit at expiration here. And then this is your targeted annualized return at expiration. Keep in mind these numbers here are to compare one trade to another. You can't expect realistically to place this one trade every 16 days and end up at the end of the year with a 250% return. So it's just really to compare one trade to another. And it makes sense that the trades with the shorter amount of duration will have the higher targeted annualized returns. It just assumes they turn over more quickly for the year. But what I like to do in a demo is I just kind of randomly choose the trade with the most time. And it's pulling up the October week 1 expiration. And here's what it looks like on a graph. So here's the current price, and it's selling an out of the money call spread and put spread simultaneously. And the end result is you're going to be collecting premium for doing so. And we'll kind of drill down here and look at this table. You'll see the weeks here, the days till expiration, the expiration date, the settlement value here, how many points it traded at, the premium, the put risk, call risk, commission, cash required. This is your profit potential maximum, targeted return on cash, and then your targeted annualized return at expiration. And you'll notice here, this is kind of the key point. We'll focus here for just a moment. We'll often get the question, and it's a valid question. I'm going to use about $900 to try to make maybe $90. And people sort of scratch their head sometimes. They might think that at first glance that sort of a inverted way to look at things or to trade. You usually want your profit potential to be higher than your risk. But keep in mind, the puts that are being sold here, selected by the algorithm, have a delta of 9.84. So that means there's over a 90% probability that these options you're selling to someone else would expire out of the money. And look at the calls here, the 5870 calls, 6.62 delta. So you're looking at over 93% probability that the calls that you're selling will expire out of the money to someone else. So that's using the math and looking at sort of these higher probability outcomes in terms of the deltas and the expirations. And we never hold something till expiration as well. And we're going to show you how to use the automation to close out your positions. But you'll notice the button here for sell is pre-selected because you're selling the condor, trying to collect the premium. Always defaults to 1, but we can change it to anything we like. You can see the cash required and your profit potential moving up. We'll go ahead and do 5 of these, and we'll leave it here at a value of 220, and we'll use that button to place the order. And it's just that simple. The demo account just assumes you're filled, so that's what it would look like. So let's go back and we'll look at a dragonfly now. So that's the week 1 expiration on the condor. You can see here October week 1. And I'll pull up the dragonfly in just a moment. I'm not sure why it's taking so long. We have been having some internet glitches here. Actually, there was an earthquake just about an hour or so ago. You could feel it shake pretty good here. Actually, we had another earthquake just a few days ago. So in any case, hopefully we get things working here again. If not, I have a couple of other ideas here, some trades that I've kind of preloaded that we can look at. In fact, why don't I do that now then? So what we're going to do here as part of ThetaTrader, there is a trade simulator. So you can go backwards in time and backtest your trades. And I've loaded, here's an example here. Let me put the screen, zoom in on that, zoom out a little bit. You can see everything here. So here is a trade, the August week 3 expiration from June 20. We can use these buttons to go forward and backward in time, or you can jump right to the end. But I want to show you kind of how this works. We'll compare this condor to a dragonfly. So let me explain what's happening. The day by day is happening, the market's trading, and you can see here the change in the S&P. It's up, it's down. The P&L on the trade, it's somewhat profitable, a little negative, a little profitable. But the green RTI says good, do nothing, and just stay with the trade. Okay, so again, we're just chopping around and the market's staying in between the upper and lower boundary. And the green RTI is good. It means do nothing. And it turns yellow. So that means your risk is getting elevated. Trade's turning a little negative now, but still do nothing. And then it's getting profitable again. And then it turns blue with 4 days remaining in the trade. And blue is a profit-taking signal. And then you can automate this so that when ThetaTrader scans your account and it receives a blue RTI signal to take profits, an order is automatically submitted and placed for you. Okay, so we're going to show you that in just a second, but keep that in mind. I want you to pay attention. That was August 13 with 4 days remaining. You have a profit-taking signal. We'll compare that to a dragonfly. So here is, make sure it's the same expiration. See here, the August week 3 condor versus the August week 3 dragonfly. So we're going to compare kind of apples to apples here. just using a condor versus a dragonfly kind of competition here. So you can see the same price action because it's the same time period and the same market being traded. But you'll notice the puts on the dragonfly and the calls on the dragonfly. We talked about the structure. So you notice there's 6 legs here, 3 puts and 3 calls, different strike prices. You'll notice the RTI is green, the P&L is profitable. And look at this, it turns blue with 26 remaining days till expiration. And that's a profit-taking signal. So you could have had this order placed for you to close out that position and take your profits with 26 days remaining till expiration, or in the condor you'd have had to have waited till you had only 4 days left till expiration. So 22 extra days in that trade. So that can be the benefit and advantage of the dragonfly at times. Allow you to exit a trade more quickly or earlier. It will mature quicker sometimes, and that's just because you own this call and you own this put and you've paid money for those, so it's an additional hedge or additional protection, and it completely changes the dynamics of the trade compared to a condor in certain circumstances. All right, and here's another example. Here's a July week 2 iron condor. Let's run through this one. You can see here it's green is do nothing, yellow a little elevated risk but still do nothing. And it goes back to green. And I just kind of point out this is so helpful. I mean, in hindsight, it's easy just to go backwards and look at this, but when you're actually in a trade with real money, a lot of times you're not sure what to do, and that's the beauty of the RTI. It tells you what to do and when to do it. And here you go. You have a red RTI, too much risk, and get out of the position, take your loss, and move on. So that's the July week 2 condor. So I just want to show you that we're not just cherry picking and only showing you winners. A condor can lose money, a dragonfly can lose money as well. But I wanted to point out the difference between the condor and the dragonfly sometimes, not always, but sometimes. So here's the July week 2 condor we just did. And here's the July week 2 dragonfly. Let's compare how they did. So again, you're placing this trade on the same day with the same expiration. The only difference being this is the dragonfly trade structure versus the condor. You can see it does turn yellow here, elevated risk, but still do nothing. Now it's profitable, and look at that. You actually get a profit-taking signal with 15 days remaining. So before the expiration date here, you have a signal here to get out of that trade, and the blue RTI is triggered, and then that would submit an order for you to close out that position and take your profit and go on to another trade. And you can see how owning this call here dramatically helped this position, because when you own this call, in this case 50 points closer to the money, and it's not always 50 points closer to the money, by the way, but in this case it is, but that means it's going to have a higher delta, and you own it, so it's going to add in value. The premium will increase at a faster rate than the further out of the money calls that you've sold, and also the theta decay will not impact it as adversely because it's 50 points closer to the money and has a higher delta. So you can see how this provided a great layer of additional insurance here, and it paid off with a winning trade versus the condor where you ended up taking a loss. Now here is an example. I mentioned how we can do any bullish or bearish strategies as well, but here's a bear hedge strategy. In this case, you're selling an out of the money call spread here. You collect money for selling the spread, and you use that money to buy an out of the money put spread. You can oftentimes do this for a credit or even money, so it doesn't cost you anything. But here's, in this example, what happens. And the colors are different when you are doing a long option strategy, so don't pay attention so much to the colors. Let's just look at what happens here. And you can see why, you have a bearish position and the market starts to move higher. So you can see why this trade would be losing money for you at that moment. But then, of course, the market starts dropping, coming in your direction. And you can see here now the trade is profitable. So just an example of a particular type of position you can place with ThetaTrader and then automate it as well. There's also something called Trade Builder. So if you wanted to just start from scratch and build your own trades, you could. Let me go back here and show you the dashboard again. Let me zoom in here. Oops. Yeah, and I wanted to point out that you have all the bullish and bearish and neutral strategies available on these tabs right here. And then we were looking at the condors and the dragonflies as well. Let me see if I can refresh this. There's something going on with the connectivity here. Sorry about that, folks. But that's why I did have some of these other simulated trades loaded. Okay, so I wanted to point out too that, for example, if you're bearish, you don't have to do a bear hedge. You could do any number of things. You could just buy a put spread. You could sell a call spread. You could just do the half of a dragonfly. You could actually buy a condor instead of selling it. So there's a lot of different variables here to consider, different approaches you can take. But what I wanted to get at here is just show you, for example, on this condor, well, let me do this instead. Just want to point out that you can actually change the strike prices if you would like. So the algo will deliver and sort of serve the strike prices and the trades to you. And if you would like, you can change them here. And it changes, of course, all the data along with it. But I think that sort of defeats the purpose of using the algo. All right, now I mentioned the trade builder. I want to point out too, we do have proprietary research. Here's something called TradeScope, and that's done daily. You'll get some technical analysis along with some economic outlooks, looking at the Fed probabilities of rate cuts and so forth here. So we do provide proprietary research as well as daily commentary. This will give you what's happening in Asia and Europe, sort of follows the sun around the globe, and in the US. And we have a looking ahead section here along with an economic calendar. So really on one page, you get to see everything that's going on. So people really like using that, sort of rely on that. Now I want to show you something important. Under my account, you go to settings, and this is where you would activate your automated risk manager by checking this box here. And then you automate the profit directive by checking the box here. Now, this is very important as well. So with the risk manager, when the RTI turns red, the default level here is for a 50 delta. But you can change that if you'd like. You could get a little more conservative. So when it turns orange at 38, then the trade would then trigger a order to exit the position and take a loss. Or you could customize it anywhere from as low as 25 up to 50. Keep in mind though, if you were to say move it to 25, that's going to mean you take more frequent losses, but the losses will be smaller in magnitude. The dollar amount will be smaller. So We like the 50, and that's based on our experience of trading millions of options. But some people do modify this, and we did allow this flexibility there. So that's a really great feature for those who want to modify some of the automation functionality. And then when you're done customizing it or what have you, just save your settings like that. So that's a really important page here on your ThetaTrader account. And then the profit directive here, you'd want to check that as well. And then there's a great help file that explains a lot of the terminology, the color coding, definitions for strategies. We're not going to go through all the details, but it's all in here. It's all right under the help file here. And then there's also a lot of videos here. There are tutorials, so everything you need to use ThetaTrader is available here. There's even background education on options if you need to kind of refresh your memory on some things. And here's step-by-step tutorials on how to use ThetaTrader. But really, you saw how simple it is. It's very intuitive, very user-friendly. And what I want to do now is I want to show you how to accept a trade alert. So if you're on your dashboard and you have a trade alert that's been distributed, you'll see it here on your dashboard, and you would go ahead and click view. So here's a live trade alert for today. And this is an example of what you would see. So you'll get a description of the trade. This is a end of month Russell 2000. This is the E-mini, has 47 days till expiration. And you can see this dragonfly here. This is the call side of the trade here. Here's the put side of the trade. And this is really important. This is a lot of fun here too as well. Each one of these alerts that you receive is going to be specifically tailored to you and your account. When you look at the quantity and the account size, you'll notice it's a default of 8, and that's based on what's already in my account and also my account balance. And when I say what's in my account as well, in other words, you're not going to receive an alert for the same trade you already have in your account. It's not going to double up on positions. And if you want to modify the quantity, you can go down, and you notice as you change it here, here's your premium collected goes up or down. The cash required goes up or down as well. So we'll go ahead and just keep that back to the default setting. You'll see here you're trying to get filled at 6.2 or higher, trying to collect $1,808, putting up cash of just over $18,100. There's 47 days till expiration. And if you want to accept that alert, you would simply accept it by touching your button here or reject it. And you can also do this on your smartphone, and I'll show you an example of that in just a second. But we'll go ahead and accept that here. And there it is. Just assumes you're filled in the demo account here with those 8 dragonflies. Now you can also look at your closed positions on one page, and let's take a look at how to do that. You can filter any way you want here with all these tools, but the default setting basically just shows you, I think, up to 20 per page here, as I recall. But so you'll notice, again, this is a demo account. I don't put any thought into these trades, so don't, look at this one way or another in terms of the results. But you'll notice there's 20 trades on the page, 13 winners, 7 losers. Sold spreads or short option positions, there were 14, 10 winners and 4 losers. Then there were 6 long positions or debit spreads, 3 winners and 3 losers. And if you wanted to go back in time and look at any particular trade, you certainly could. Here's a condor here. We'll click on that, selling these 5 condors. And you scroll down and you can kind of review what happened. Here's where the market was trading when you placed that position. It ran up and then came back down, and then it was closed out for a profit. You can see obviously it got to an orange RTI, which is elevated risk, but it didn't quite reach a red RTI in this example. and then the trade actually worked out just fine. But that's an example of just going back and looking at closed positions. Don't need to spend a lot of time on that. And you can go back to, I can just point out here, this is where you find the trade simulator. Remember, I just went and kind of looked at some of these backward or back tested trades there. All right, and here is probably the best feature of all, and it's really the smartphone alerts. So let me go ahead and switch screens. Give me just a second, folks. All right, so these here are the alerts that you would receive on your smart device. So the same alert that comes to you, it basically just gets sent to you via email. It'll show up on your dashboard and it'll show up as a text message. And you can respond in one touch with your smart device. And then the order is submitted via our technological wizardry. And if it's filled, then it populates your ThetaTrader account, and then you can have the RTI automatically track it and close out that position for you in the future. So these alerts are live, meaning they're integrated with your AltaVest trading account. And to simply accept the order, you just touch your screen. So here's an example. You'll get a text message. It's a hyperlink, and you'll touch that message. And you'll see a description of the trade. You'll get a graph of the position. In this case, it's a S&P Condor. You'll see the amount premium you're trying to collect in this case, the cash required, the quantity here, selling 10, and you can also modify that quantity by going down. You can never increase the quantity on an alert, but you can minimize the quantity and reduce it. And you'll notice, so this is all pre-selected for you. The quantities are pre-populated based on your account size, and also the trade selected for you is based on what's in your account already. And that's it. If you like it, you just touch accept, and then the order gets transmitted, and that's it. So we'll just look at that one more time, how simple that is. I won't stop it this time. All right. So this is a really, really unique idea that I don't think exists elsewhere. The trade alerts, those interactive one-touch alerts, and also the highly institutional style of trading with these complex spreads that can have up to 6 legs, and making it user-friendly for the retail trader such as ourselves. That's what ThetaTrader was designed for after trading millions of contracts over the years with clients. That's why we developed ThetaTrader, to make these professional style strategies available. So here's how you can get involved with a ThetaTrader membership. It includes all the software that you just saw demonstrated. So you get the Theta trades, the RTI, and the trade simulator where you can backtest, go backwards in time, backtest any strategy. I think there's probably 15 years of data perhaps by now. And it's really a time machine. So that software valued at over $3,500. And then you get those one-touch trade alerts. Remember, these alerts are integrated with your account. So you don't have to receive an alert and then log in to some other third-party account and try to copy an alert. All you do is touch accept or reject on your device, your screen. And once the order is filled, then the RTI can also automatically manage that position for you. That value there of over $4,400 for those alerts. So again, the ThetaTrader membership includes all the software that we just saw demonstrated, and that includes the one-touch trade alerts valued over $8,000. And then what really sets it apart is you get private coaching, your own personal caddy from one of us. You get 1 hour screen sharing sessions and lessons with someone who's going to be Series 3 licensed and experienced. Anyone here has decades of experience. So you really have a co-pilot to kind of help talk you through what your goals are, discuss your trading history, your strategy. The value there at least $7,500. I know people spend $25,000 for education online, and that's fine, but what we're telling you is ThetaTrader membership provides you everything you need. And again, the software, the alerts, the private coaching valued at over $15,500. And this is kind of corny, but that's okay because I just don't want you to forget you get all of the proprietary research as well. And people really like to lean into that. So, and it's convenient. It's all part of the ThetaTrader membership and the online video tutorials that's just included in ThetaTrader as well. So to summarize, I won't drag it on. I know you're all waiting to hear what the price is for that membership. It's not going to be $18,500. This is what we used to charge. We would do in-person events. It'd be $4,000. Have people lining up in the back of the room, signing up at tables, that type of thing. Of course, we'd like to do these webinars. We can reach a lot more people that way. And our price here discounted way down to $597. Here is the link, cf.altivest.com. Let me type that in. /TT. And that's my direct phone number and email. So why don't you take a screenshot of that if you would like, so you don't forget. You can reach out to me anytime. Of course, oftentimes people call me as I'm still talking, and that's fine. It gets transferred to someone else or it goes to voicemail. But there's the link. There's the order form. It does expire, I believe, Sunday night, if I'm not mistaken. And yes, the offers do expire. And there's a 30-day money-back guarantee. So really, you don't have any risk on your membership fee. You're welcome to sign up. And if you decide it's not for you, no worries. We just refund that membership fee. If you want a free membership, $100,000 accounts and more receive 100% rebate, or even a 50% rebate if you have an account over 50,000. And people love to take us up on that offer. So a few FAQs. Tax efficiency. Some people ask about that, and if you weren't familiar with it, futures and options are tax efficient because they're treated differently by the IRS. These are called 1256 contracts. IRS section 1256, I believe, is the technical way to look at it. But your capital, your taxes, 60% of your gains are taxed at the lower capital gains rate. I won't go through this example, but it makes a big difference. Big difference, probably about a 10% difference in your net result compared to trading something in a non-tax efficient space. And there's no more itemizing. I thought this was a good picture here. This guy says, my accountant going through all my trades, reporting a 37-cent profit. Kind of made me laugh. So everything is just one number at the end of the year on your 1099. There's no more itemizing. So always consult your tax attorney. An IRA, yes, there may be some different requirements. We have people transferring IRAs all the time to us. And again, why the E-minis? And well, they're liquid, they're efficient, and they're cost effective. Large market share, they have densely packed strikes, 100 annual expirations, ensure granularity and coverage on these E-minis. You get superior volume, execution, according to the CME group. ES options have a cost savings of $4 to $15 per contract compared to SPX options. So you have the tight bid offer spreads. So you have that deep liquidity and a wide array of maturities. And here's a graph I put together to give an example. So imagine you're doing a condor or a dragonfly, and here are the calls of the puts here. And as time goes by, the algorithm is searching for new calls and new puts to trade. And there's so much strike price availability and expirations available with the E-minis, then here's a new set of calls and puts that the algorithm is going to find. And then here's another set of calls and puts. So you have that liquidity and that depth. And it's important if you're doing the dragonfly, and this is really important to keep in mind, you cannot do a dragonfly, at least I'm not aware of it, and I've been on probably 5 or 6 or 7 of the big box brokerage firm platforms as one order. You can't do a dragonfly as one order if you're trading securities. So if you want to trade, shares of whatever, I don't know, what's the hottest thing? I don't know. Walmart was I think up today, right? So you're not going to be able to place a dragonfly option spread on Walmart as one order. You have to break it up into 2 orders and then leg into it. With us, of course, you saw how easy it is to do. It's the way we've built ThetaTrader to package up those 6 different legs. So you get one order placed as one trade at one price. So no legging in and legging out of 2 separate spread orders. And you have this immediate access to these sophisticated option strategies when you're trading with us and these E-minis and using ThetaTrader. So compared to the retail stock options trader, this woman here says retail investors only have access to the most basic call and put options. She's talking about most retail options traders. They don't always have access to option spreads or other more sophisticated strategies. And remember too, the pros are just not option buyers. They don't just buy options all the time. That's how rookies trade. If you're only buying stock options, time or theta is always working against you. This is the woman here in this interview. If you want to look at that on YouTube, it's a good interview actually. She makes some great points. As you can see, I'm quoting her. The appeal for a lot of the retail investors to buy options is that options are much cheaper, but your potential for profit is actually not that high. In 2021, 11% of Robinhood active users made options trades, but of that, fewer than 1% actually made multi-leg options trades. So what she's saying is the typical retail stock option trader is not sophisticated. And what we're saying is ThetaTrader can bring these sophisticated strategies right to you and make them user friendly. Why not just track 2 or 3 different markets, not thousands of different individual securities? There's efficient margin, and there's a clear cost structure when you're trading with us. There's no hidden cost with the same way you would get with in the security space. So everything trades at the Globex electronic exchange. So every order is treated equally at the world's largest futures exchange. So there's no free trading. I'm sure you're aware of that, folks, but there's something called payment for order flow. So Robinhood will sell their customer orders to a third party, and then they say you're getting commission-free trading. But the problem is orders are executed at prices inferior to other brokers' prices. So it's not just Robinhood. Anytime they say free trading, it's not free. It's just you're paying a larger spread essentially on the trade. So none of that with us. We just have a competitive commission rate, 5.25 round turn all in. And this was taken from a big box brokerage firm. They say they're 2.25, but that's per side, so that's only half in. Then you pay the same amount when you get out, and then they have more fees on top, like clearing and exchange fees. It ends up being higher than what we charge, so our rates are competitive. What is our performance? Well, everyone's different. We're a brokerage firm, so everyone uses ThetaTrader differently. They're self-directed accounts. But I do want to point out that everything is net of trading cost in ThetaTrader. All the percentages and all the dollar figures are net of all trading costs. What size of an account? Our suggested minimum is 10,000. And again, if you want to have a free membership, you can do so with 100,000 or higher. If you have a bit less than 20,000, let me know, and I'll see where you are, and we'll talk about it. Again, any kind of trading account, we can do it, just like any other brokerage firm. And why would you even consider ThetaTrader or sort of an alternative approach? Well, it may improve diversification and lower portfolio risk. And of course, risk of what or from what? Bankruptcies are soaring. This is just from 2 or 3 days ago. I took this. Small business filings up 61%. Wow. Highest bankruptcies since 2020. Will the Federal Reserve save us by lowering rates? Well, keep in mind, here's an example. Anytime in the past, I think almost every time in the past, a recent history, when the Fed has lowered rates, that's a sign of an upcoming recession. So, the Fed starts to cut for a reason, because they see a recession coming. So keep that in mind, folks. Rate cuts aren't necessarily, and with a recession, it doesn't mean the stock market has to crash, but there is definitely a high correlation there. When you get into recession, stocks do not typically do well. You can see here this graph. Every time the Fed cut, you get a subsequent drawdown in the stock market. See, the blue line drops, that's the Fed rate cut, and then big drawdown in stocks. Same kind of thing here, 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 here. So a rate cut is not good for stocks. Just another way of looking at it here. And inflation, I don't have to remind you, but inflation adjusted, the S&P 500 is, well, almost nowhere since 2021. So even if you're passive, you're still not really beating inflation. So something to keep in mind. Here's stagflation. You get slow or no economic growth and sticky high inflation. You have average hourly earnings lower when they're adjusted for inflation. You've got that inflation shark chasing this poor guy with his wages t-shirt on. So I don't know if a recession's near or not, but we should be on our toes. I've heard everyone talking about the SAM rule, Claudia Sam, that economist. She came up with this rule about unemployment rate, the 3-month moving average. When it rises, a certain percentage, then basically the last 9 recessions have been triggered by that rule. So I guess here we are now. It's been triggered. Is it going to happen? We don't know. Here's a close-up view of that chart. So I don't know if this time is different or not. Leading economic indicators are all negative for, I don't know, it seems like 20 months or something. Recession warning. Government spending is dropping, and that was a big factor in keeping the market buoyant. I think we could all agree to that. When you print money and spend it, that's what happens. You inflate asset prices. The yield curve inversion, that gets a little bit wonky, but basically all you need to know is whenever the yield curve has inverted, and as it starts to uninvert, whoops, go back. You can see as it starts to uninvert, the gray boxes here, the gray vertical lines are recessions. So you see the red arrows showing you the yield curve going from negative back to positive, and here we are. It was deeply negative. It's been negative for, gosh, seems like almost 2 years, but now it's heading back to positive. So we're going to get another gray bar here, a recession ahead. So just to review the benefits, you have strategies for any market condition. You don't always have to choose up or down. We're not day traders. Over a 5-year period of time, there's a less than 1% success rate in day trading, according to this quantified strategies research paper. I kind of had to laugh at this graph. So that's a difficult thing to try to figure out. I'm sure you would agree. There's a margin of error on these types of trades we're doing that we just saw today on the, say, example, the dragonfly or the condor. I think it saves you a lot of time. A lot of us don't have time to spend 10 to 12 hours a day consumed, like this guy here. And also it's alternative. It's not relying on the market always going up every day. So that's why it's also something to keep in mind. You have flexibility with these go anywhere option strategies. A little more global macro chit chat here about the Warren Buffett indicator. You have basically is looking at where the stock market to GDP ratio is, and that's, I guess, at another record, highest in history. Could keep going higher. So, the S&P, people think, oh, I'm diversified. Well, not really. Top 5 stocks were 29% of the S&P 500. This is as of, I think, a month ago, but I don't think it's moved that much further. Here's the equal weight S&P 500. You see the big gap there. So that's kind of the same theme. What that's saying is if all the stocks held an equal weighting in the S&P 500, your gain would be maybe, what would that be, 7% or something year to date, not 16 or 17%. So really, majority of the gains in the S&P are in the really, really large cap, the Mag 7 type of stocks. But anyway, Wall Street uses option spreads. We think you should too. As you know, what option spreads are, buying and selling different contracts, common way for investors to hedge risk and volatility, and usually cheaper because you can offset your cost by the proceeds from different contracts. So absolutely, and it's been used by Wall Street for decades. So we'll just kind of wrap it up here, and then I'll have some FAQs if you want to shoot me a question in the chat or anything. So you get all of the option software we talked about with the personal coaching. So you'll sign up here, and then you'll see the 5 steps that'll happen. Just complete the order form. You'll soon receive your login credentials. You can start using ThetaTrader in demo mode. Then you'll get account opening instructions. Once the account is open, you can fund the account and then begin trading and accepting alerts. So we definitely want to try to help you control your emotions when trading. I think the automation can help in that regard. Algo-driven options strategies for any market condition. You've got that trade simulator to work with. It's actually quite a bit of fun to use. You can just go back in time. And then you have those one-touch trade alerts that'll be sent to you as well. That's all part of ThetaTrader. So here's what it looks like. It gets emailed to you or shows up on your dashboard, and then also comes to you on your phone. And then you just touch accept. So here you go, folks. You want to take another screenshot here, the last image there, and let's see if there's any other comments or questions or thoughts that I didn't get to. I think I've actually covered a lot of ground. Let me see here. Any questions? And I will make sure here you get that link here. Yeah, very good. Yes, you do have to have an account with us with AltaVest. So I thought I'd make sure that was clear. So yes, just like any other brokerage firm, you just follow those steps to open your account. First step is to become a member, and then we'll get you onboarded. And remember, you got the 30-day guarantee as well. And let me know if you have any comments or any other questions. I'll be glad to help you out. And we're going to call it a day, and that'll be a wrap. So thanks for joining me, and we'll talk to you soon. Bye-bye.